If you've ever Googled, how do I get a small business loan? This video is exactly what comes next. My name is Nicole Dambro, and I'm a lender working in the SBA and commercial financing space. And my firm just ranked number 39 in the country, not for loans that we've pitched, not for loans that we booked, but for loans that we've actually closed. There's a difference. Today, I'm breaking down the SBA 7A loan, what it is, how it works, who qualifies, and what most people get wrong about it. This is the complete novice's guide. So, whether you've heard the term 100 times before or never, you're in the right place. Let's get into it. The SBA 7A loan is the most popular loan program offered by the Small Business Administration. And when I say popular, I mean the SBA guaranteed over 70,000 of these bad boys in a single fiscal year. It is the flagship, it is the workhorse, it is the one you've probably heard all about and have no idea what it entails. And that's okay. Here's the simple version. The SBA doesn't actually lend the money. A lender lends the money. And the SBA guarantees a portion of the loan, meaning that if you default, the government backs up the lender. And that guarantee is what makes banks and lenders willing to say yes to deals they normally pass on. It's the reason why a business that's been open for 2 years with decent credit can still get millions of dollars in financing. That's the whole concept. The SBA is the safety net that makes that deal possible. Besides favoring small business, what are the perks of SBA 7A loans? First of all, there's a very flexible list of uses, like working capital to cover payroll, inventory, operating expenses while you grow, marketing and promotion, equipment purchases, buying real estate for your business, refinancing existing debt, and this is a big one, buying a business. If you've ever thought about acquiring an existing business, the SBA 7A is the most common ways that people fund that. And we close a lot of these deals, so we know they're hot. Next, SBA 7A loan amounts and terms are very attractive. The maximum loan amount for a standard 7A is $5 million. However, certain industries can now go up to $10 million, like manufacturing, for example. As for the minimum loan amount, every lender has their own opinion. At our firm, we have a minimum of $350,000, which is pretty standard from what we see in the industry. But there are lenders that will still do smaller loans. Okay, now let's talk terms, because this is where the SBA really wins. Repayment terms depend on what you're using the money for. So you're looking at 10 to 25 years. Working capital loans, 10 years. Equipment, 10 years. But you throw in real estate, now you're at 25 years. Compare that to a conventional loan where you might be looking at 5 to 7 years, and you start to understand why the monthly payment on an SBA loan can be significantly lower. For SBA 7A loans, interest rates are either floating or fixed, and they're tied to the Wall Street Journal prime rate, not your credit score. Most 7A loans are floating, meaning that your rate adjusts quarterly with the prime rate. Now, I'll be straight with you. Rates can go down, and we anticipate that they will, but they can also go up, and nobody can promise otherwise. What I can tell you is that right now we are near historical higher rates. So even so, this is still one of the most competitive financing tools out there for small businesses. So you're not choosing between a good rate and a bad rate. You're choosing between access to capital and no access to capital. As for equity, how much money do you actually need to put down? So the SBA typically requires a 10% equity injection for acquisitions, equipment purchases, real estate, but startups get bumped up to 15% because they need to see more skin in the game. As for working capital and refinances, that's a whopping 0%. This is huge compared to other loan instruments out there, which require 20 to 30% down. Oh, who qualifies? I just want to be direct with you here because the internet is full of vague answers. But to be eligible for a 7A loan, you need to be a U.S. citizen operating a for-profit business in the United States. You need to meet the SBA's size standards, which vary by industry, but generally mean that you're a small business and not a Fortune 500. You need to be a cash flow positive company, not just your financials, but on your filed tax returns. What we're looking for here is the ability to repay, meaning that the business has to generate enough cash flow to cover the business debt. Lenders look at what's called your DSCR, your debt service coverage ratio, but I'll do a whole separate video on that. Regarding the borrower, we look for 3 major criteria: credit,
liquidity, and experience. Most lenders want to see a personal credit score of 680 or higher, although some will go lower depending on the circumstances and the deal. We're going to take a look at your liquid assets like your cash, bank accounts, stocks, retirement funds, and more to see if you can cover the required equity injection. And lastly, especially in business acquisitions or startups, a resume will show us your education, experience, and any relatable skills for the business that you're buying or starting. But here's one that you probably haven't heard of, but us lenders discuss ad nauseum, and that's character. It's important to be honest and forthcoming with all of your documents and your application. This includes putting real numbers on your financial statements, letting the lender know of any challenges in the business, and being proactive about sharing anything that the SBA might flag in your background check. This also means being honest about any active lawsuits, including divorce. This is usually an automatic no for lenders, but if they're in the past and you have a reasonable explanation, it might be a go. Now let's talk about the one thing that scares everyone away from SBA 7A loans, the timeline. You've heard the horror stories, the deal that took 6 months, the one that fell apart at closing, the endless document requests that felt like they were going in circles. I hear this all the time from business owners and buyers who want an SBA loan, but they're terrified to pull the trigger because of what they've heard. So, let me tell you what's actually happening in these horror stories. The timeline is mostly on the borrower. I mean that with love because nobody ever says it out loud. But the number one reason why SBA deals drag on is because of borrower responsiveness. How quickly do you get your documents in? When a lender asks you a question, does it get answered that day or does it sit in your inbox for 2 weeks while you're busy running your business? Do you have your last 3 years of tax returns organized and your year-to-date financials, or are they ready to go, or are you hunting for them when somebody asks? Every single day a document or a request goes unanswered is another day added to your closing date, exponentially. That back and forth is where the months go. The second reason that deals slow down is because you're starting with the wrong lender, and nobody explains this part. But most banks and lenders have a business development agent who picks up your deal first. Their job is essentially to shovel you into a pipeline until someone more qualified can tell you whether or not your loan's actually going to move forward. And that pipeline has levels, multiple levels. So when you call to ask what's happening to your loan, the person you're talking to genuinely may not know because your loan is sitting 2 floors up waiting for a decision that they're not even a part of. And that's why you go days or weeks without real feedback. That's the silence. It's not malicious, it's purely structural. And when a problem surfaces, which it will, it gets kicked back down through those same levels to the person who originally worked with you, who often doesn't have the authority or the full picture to help you fix it. So now you're waiting again. Yeah, it stinks. But we built our entire process to work the opposite way. So every person on our team has access to your file. Anyone can pick up the phone when you call and actually answer your question or get back to you expediently. And when all of your documents are in, we issue a pre-approval within 48 hours, a clear yes or no with specific notes on exactly what you need to move forward to the next step. No mystery, no waiting. And this is why my firm closes SBA loans every week. Here's your quick reference summary before you go. SBA 7A, the most flexible federal loan program for small businesses. Government-backed guarantee that makes the deal possible. Up to $5 million. Terms 10 to 25 years, depending on uses of proceeds. Covers working capital, equipment, real estate, acquisitions, refinancing, and more. Credit score, generally 680 or above. 10 to 15% down payment. Timeline is 60 to 75 days with the right lender and a responsive borrower. If you're exploring whether an SBA 7A loan makes sense for your situation, or if you've already started the process and it feels a little off, that's exactly what we do. So reach out, the link is below. And if you want more of this, subscribe. I'll be putting out content all the time breaking down SBA and commercial financing in plain language. Because honestly, somebody has to do it. Thank you so much, and I'll see you guys in the next one.